Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It's the 9th of February, 2024. I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. And if you like what you're hearing, you can go to renmacaccess.com and get access to some of our watered down thoughts. Still very, very cogent and topical, but not quite the same heft and details as what we give to the institutions, which is probably overload for the average investor anyway. And if you like what you're hearing, make sure you give us a thumbs up click. Those reviews are important. Well, let's start with you, Steve Pavlik. I mean, we knew the ship was taking on water, but is it listing now to the point that it's irrecoverable?
Assuming you're referring to Joe Biden, and is that a fair assumption?
Yeah, that's a fair assumption.
Okay. Look, in terms of the special counsel report from Robert Hur, I guess for Biden, there was the good, the bad, and the ugly. The good is that Hur's not going to prosecute him. I don't think that's surprising. Hur also went to great levels in his 345-page report to point out some of the differences between Biden and Trump in terms of how they responded when they were both caught with classified materials. I think what he left out is that Trump's going to argue he had the ability to retain those materials because the presidential powers. Now, people will dispute that, but again, that was something I think that was conveniently left out. That's an important distinction. The bad for Biden, again, I'm not a lawyer, but listening to people who are, is that Hur found he willfully retained the documents, which is a polite way of saying intent, which is what you need to for a crime. And I think that sort of feeds into Donald Trump's two-tier system of justice argument, where Trump's going to say, well, wait a minute, I was also caught with classified materials, but you don't prosecute Biden, but you prosecute me. The ugly for Biden plays into the decision not to prosecute with him, which, if it sounds like I misspoke, I didn't, because what Hur actually said is, considering to bring forth prosecution, you need to consider the ability whether or not you're going to win conviction in a trial. And from Hur's perspective, having interviewed Biden, he found him to be more or less a polite way of saying senile. I think he said, very forgetful at times, an old man. And he referenced several instances where Biden could not remember the times when he was vice president, his son's death. Now, Biden pushed back on this. He went and had a hastily arranged press conference once he saw a lot of the reports and the news coverage of this to take issue with that characterization by Hur. And he made matters worse, because in that news conference, he confused the leader with Mexico with the leader with Egypt. And this had come after there had been several reports all week of Biden confusing these leaders. So in essence, he reinforced the characterization that Hur was arranging. And I think you asked me last week, was the economy Biden's Achilles heel? And I said, no, it's cognitive ability. And I think what's notable is, here we are ahead of Super Bowl weekend. This will be the second year that Biden's not going to do the Super Bowl interview. And that's something that presidents traditionally do because it's softball. The networks always cover it. It's a large audience, and they're not going to get into the gotcha stuff that they do on the Sunday shows. And a lot of people think that the absence is just a reflection that his team does not have confidence that Biden's going to go out there and reinforce what people are saying. And look, to be fair to Hur, these polls are all saying the same thing, whether they're Republicans, Democrat, Independents. The polls are very clear that people have concerns about Biden's cognitive ability. So if that was a concern,
knows that Grandpa Simpson is in the White House. That's the bottom line. Everybody.
Trump 2024. Only I have the mental acuity to commit a crime.
Oh, that's pretty good. All right, Neil, we'll take that quip and turn it into the inflation adjustment.
I got so many things, man. I was telling you, there's like more stuff going on pop culture wise than like you got Fast Car with Tracy Chapman and Luke Combs. If you haven't seen it, go see it. Jay-Z did his best Kanye impersonation at the Grammys, basically taking a dump on Taylor. He's just so salty, like that Beyonce never. He was complaining that Beyonce never got Album of the Year, even though she has the most Grammys. It was so pathetic. I can't even tell you. I lost respect for him. Anyway, and then you had this, and now you have The Rock turning heel before WrestleMania. You got the Rocky sucks chants all over social media, all over wrestling shows. It makes me think like I'm back in the 90s as a geriatric millennial. Speaking of which, the 90s, one of the things I've noticed is that the consensus only has GDP growth this year. They don't have one quarter, Jeff, above 1.5%. So if you go out 4 quarters this year, not one is above 1.5%. And we're tracking over 3. Okay. And when did this happen? It happened last year too. Okay. And it was also happening with relative frequency in the years preceding the pandemic, right? Like, so you had, and that's a dramatic departure from what happened during the 2010s, right? Like in the 2010s, if you recall, we went into the year at like 3%, and by the end of the year, we were at 1.5, 2. So, and that happened year after year, really, until 2017, 2018. I think when you have that situation, like when you have this sort of repeated missing on one way or the other on growth, like where the consensus is too cautious and then by the end of the year revises up growth and it keeps happening, that is basically what happened in the 90s. And the reason it happened is because productivity is notoriously difficult to forecast. Okay. And if productivity is picking up, which it is, then it's keeping unit labor costs under control. And that means that it's keeping inflation under control. And believe it or not, unit labor costs have basically been negative for the last 2 quarters. We'll see whether this is the start of something meaningful or just a one-off blip. But, I think at a minimum, with people sitting in their jobs longer, the quits rate is down. The longer you keep the seat warm, you get better at the job, and that makes you more, and then you become more productive, right? And so I think that's something worth watching, and that's even before AI. I was doing meetings in Toronto this week, and some of the clients had a lot of enthusiasm for AI, but notably, what's important to note is that if we're talking about it, it's not in the data. Right? I mean, it takes time for people to understand the technology, gain the most out of the technology before you really see the productivity boom. Like as an example, like the personal desktop computer, that was introduced in corporate America in the early 1990s. It wasn't really until 97, 98 that you start to see productivity take off. So if productivity is already starting to normalize, rising about 1.5 to 2%, even before the AI stuff shows up, it's something worth thinking about in terms of sort of upside risk scenarios to growth and markets. So it was a pretty light week for us on the data calendar. That's why I made all these pop culture references. Next week,
inflation, because that was a big deal last year. This inflation adjustment, which comes out today. What is that, and why is it important, and how do you see it this year? Maybe it's unknowable, but what do you think is going to happen?
It's usually not important. It was important last year because obviously we were all much more attentive to it, and essentially whatever progress that a lot of the progress that we had seen was kind of undone, and that's why it was that's why people are focusing on it now, because people are worried, like, is the progress that we saw towards the end of last year, is that going to be undone by revisions, seasonal adjustment, whatever? And I'm skeptical of that, primarily because household and business inflation expectations are coming down. So to me, that's a little bit more challenging. I mean, you may see some revisions one way or the other. Maybe shelter's a little bit weaker, maybe some other areas a little bit firmer. But overall, I think the overall slope of the story remains the same. And for the Fed, it's household and corporate and business inflation expectations that should matter, not necessarily realized inflation. And so I think because inflation expectations are a lot lower now than they were a year ago, that leaves me somewhat optimistic about what these revisions will show. I think it'll be more confirming than anything else.
Yeah. So the Bloomberg Commodity Index made a new low, or very close to it, this week. I've been on the road the last couple of days. China is actually getting into the zone for us that's so bad that it's good. We've gotten capitulation signals in our trend work. We've seen this our SERM, which our standardized excess return model, is in the bottom 2 percentile of historic risk-adjusted returns, which is usually that sort of contrarian point. And we've obviously seen an exodus in terms of flows from Chinese-related ETFs. So all that's really the combination that we look for at a bottom. What I wanted to ask you, though, Neil, is when we think about this, in terms of inflation, how big of an impact do you see China being on the inflation story?
I don't think it's that big of a deal. I mean, I think we're obviously going to import a little bit of disinflation from China, but it's important to keep in mind that for the U.S., I mean, exchange rate movements have very limited impacts on consumer prices because the U.S. is a relatively closed economy. So exchange rate movements don't have as much of an effect on core inflation. The typical sort of rule of thumb in kind of the workhorse model that the Fed uses is basically every 10% move in the dollar, and the broad dollar index swings core inflation by about 0.2% 4 quarters later. So if you get a 10% increase in the dollar, then core inflation will go down by 0.2%, and if it goes down by 10% the dollar, then the opposite will be true. So that's a very limited exchange rate pass through. I mean, countries that show more exchange rate pass through, I mean, I'd look to the north, Canada. Obviously, it's a relatively smaller, much more open economy. Europe is another one. I mean, you have more exchange rate sort of effects to consumer prices. The U.S. not so much because merchandise trade is not as large of a share of our economy as it is for some of those other countries.
So, we did a chart last week, and it actually didn't have as much blowback as I thought it would be. It was, regarding the Real Clear Politics polls and the, outcome when Trump's leading, the annualized performance of the S&P, when Biden's leading, the annualized performance of the S&P, and it's stark. It's 34% when Trump is leading. It's about 3.5% when Biden's leading. It's a very naive poll that was just done. The client asked us to do it, so we ran it through the machine. What we didn't do is look at what other cause and effects might be. Obviously, inflation, the 10-year yield, the Fed, liquidity, all these things probably have an impact on the S&P as well over that same time frame. So we looked at it, and we did the math on it, and I can give you some examples here. Triple B spreads had no relationship on the S&P over that period of time, week to week, right? So I look at what this week, and I compare it to what the S&P does next week. The 2-year yield had a slight, albeit very insignificant, but slight impact on the positive impact on the S&P. The Fed fund regime, are they hiking, are they easing, had a little bit more of an impact, and then inflation had the T-stats a negative 0.49, and as you know, that's meaningless. So there was something there, but nothing that's statistically significant. Net liquidity, which is some of the things that Howard talks about in our Monday morning macro, that's the reverse repo and the TGA account and all those things in terms of the sort of net liquidity in the system and how that impacts that. That does have a statistically significant T-stat of 2.00, with obviously a positive relationship there. So the more net liquidity there is, the better the S&P the following week. That poll that we referenced, though, which I thought was interesting, had a T-stat of negative 1.09. And while that's still not significant statistically, it's far better than what we saw from inflation, triple B spread, the 10-year yield, and Fed funds. So as much as I'd hate to think that this is important to the market, that the market can't see through it, clearly we need to pay attention to what's happening in the polls, or at least if we ignore it, it's at our own peril. One of the things that we are starting to see is sentiment is starting to percolate a little bit. We're seeing the II bull-bear spread now in the top 90th percentile, so only 10% of readings historically being higher than where it is today. That tends to be early. It's not a very good timing indicator. It gives you an idea as to what's going on. When we look at sentiment, we need the collection of the sentiment indicators being really more enthusiastic and showing that everybody's participating the same way. Certainly, we're leaning in that direction, but we're not at a point where we think we can make a sentiment call here. So I want to be very careful around that, but certainly at the same time want to be cognizant of its positioning. I think the big thing for us right here is going to be banks. Can we hold the oversold condition? Obviously, they've taken a little bit of talking about taking on some water. They've taken up a little bit of water with the concerns around REITs and what we're seeing locally here in New York. Also, the idea that China will see some type of liquidation and their REIT exposure is pretty vast and global in nature. So we'll continue to watch that. But remember, these are uptrends and these are old stories, right? They might intensify, but they're old stories. It's an uptrend, an oversold condition, an uptrend in our work historically is viable. So we get an oversold condition in banks, and we will certainly be looking to be adding to exposure, not reducing the exposure there. Steve, one last thing. My second home state of Colorado was being put to the test through the Supreme Court. What has the Supreme Court said about the ballot so far?
Well, they had the hearing yesterday, and I think we're gonna have to wait probably not too long for an actual ruling, just because you have a lot of states moving forward with the primaries and alike. But based on the questions asked by the justices, which tend to be a good indicator, my guess is you're looking at probably at least an 8-1, if not 9-0 ruling. Even the two of the three liberal justices poked a lot of holes with Colorado's argument to remove Trump from the ballot, those being Elena Kagan and Ketanji Brown Jackson. Justice Sotomayor was a little more sympathetic, maybe not surprising, to Colorado's argument. But I think what Chief Justice Roberts is going to try to do is draft an opinion in an era of hyperpartisanship that really shows, again, at least 8-1, that Trump will remain on the ballot. I think Trump referred to yesterday as a beautiful process. And so he was sort of pleased with the outcome there. So
A beautiful process, boy. I mean, yeah, engineering meets the humanities. I guess that's good. What do you have on store in DC next week?
well, again, we'll see if that Supreme Court decision comes out next week. That may be a little too soon, but I think we all know where it's headed. And then what to watch is, well, many of us will be watching the Super Bowl. We'll see if the Senate is going to be in session. It looks like they probably are, to move forward with this supplemental package without the border security measures that sort of fell out this week. 17 Republicans joined Democrats on Thursday to move forward with discussions on the package. They still need to work out an amendment sharing proposal there. And, I think it's probably looking more likely that the aid package for Ukraine, Israel, and Taiwan will probably move forward in the Senate. Whether it will be dead on arrival in the House, I think remains to be seen. You have unclear signals from Speaker Mike Johnson, who did not have maybe as bad of a week as Biden, but definitely didn't have a great weekend himself. And I think that's going to be the thing to watch there, whether or not the House will pass it or try to separate the two. But, time's not on the side, I think, of these packages. The longer they hang out there, the less impact they have. And just in Ukraine, I mean, you had Volodymyr Zelensky, the president there, getting rid of his high-ranking general. I mean, usually you don't make a change in course if things are going in the right direction. So I think that tells you something.
Yeah. Neil, what's the deal look like next week for you?
Well, this weekend I'll be celebrating the 16th anniversary of the 18-1 New England Patriots, obviously. And we also have stacked data next week. We have CPI, that'll be for January. We'll also have retail sales for January, and some of the early regional manufacturing PMIs. Remember, these have been all over the map. I mean, the Empire number, a lot of folks kind of latched onto that in January because it cratered. Even though, believe it or not, that was the month where the ISM Manufacturing New Orders Index rose above 50. So, I think it's an open question, the utility of some of these regional PMIs. I mean, they're not even particularly good for forecasting what's happening with the ISM anymore, let alone actual production. So, we'll keep an eye on that. And then we also get industrial production for January. So, the big news will be the January data set, CPI, retail sales, industrial production.
Right. Well, in the markets, we're going to be watching obviously levels 4,800 and then 4,600 as support. But again, we're still on a very clear uptrend here. The important thing has been breadth. And if we look at the 9-week consecutive wins that we had to end the year 2023, we've really been following that path very nicely, which is, again, this escape velocity. The market continues to go. It does not revert, as I think a lot of people's guts, including my own, would have expected, that you get some type of reversion after those big moves. However, from here, we do tend to see a differentiation in breadth. So if the market's going to continue for the remainder of the year, we want to continue to see breadth firming. And we look at that through the 20-day highs. Continued high level, if not expansion to 20-day highs, would obviously be bullish. Contraction of those 20-day highs would start to wear on the forward returns and the duration of this rally. So either way, you have about a quarter's worth of strength after you get those 9 consecutive weeks, and that puts us at the end of March. So still looking at that as a target. And then when we start to see, or if we start to see the breadth peel off, that's really the differentiator from that point forward. So it's going to be really important here over the next month to continue to watch that. And we're all hoping that the 20-day highs remain relatively elevated and continue to expand. Thank you for joining us this week. As always, we will be back next week, 1 week older, 1 week wiser. And again, if you are looking for additional insights, follow us at RenMacAccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.